Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoan here. This is brought to you by Real Approved Incorporated, a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're discussing some significant shifts in the Toronto real estate market. The average price for all housing types in the Greater Toronto Area stood at $1,022,143 in August, marking a 5.2% decrease from August of last year. This drop is encouraging first-time buyers, but leaving many sellers feeling uneasy.
That's right, Sandy. It's a mixed bag out there. On one hand, first-time buyers are seeing this as an opportunity to enter the market at a more affordable price point. On the other hand, sellers are concerned about getting the value they anticipated for their properties. What are your thoughts on this?
Well, it's a classic case of market dynamics at play. Sellers who were hoping to cash in on higher prices might be disappointed, but for young families and individuals looking to buy their first home, this drop provides a much-needed break. It's all about timing and perspective.
Absolutely. And it's not just Toronto feeling these changes. The ripple effect is spreading to cottage country and small-town Ontario. Sellers in these areas are experiencing a tough summer as Toronto buyers pull back. Real estate agent Alexis Victor mentioned that when the Toronto market is soft, it directly impacts areas like Lake Simcoe and Lake Couchiching.
That's an important point, Steve. Many people in urban areas are looking to escape the high costs and traffic of city life for more rural settings. But with the current market conditions, they are finding it challenging to make that leap. Some are even waiting for Toronto prices to rebound before making a move.
Yes, and it's interesting to see how different segments of the market are reacting. For example, some sellers are opting to rent out their properties to generate income while waiting for a more favorable selling environment. Real estate agents like James Warren and Alexander Obradovich are advising clients to consider such options.
Right. And it's not just about selling or buying, it's about finding creative solutions in a challenging market. Whether it's leveraging rental income or adjusting expectations, it's crucial for both buyers and sellers to stay flexible and informed.
Indeed, flexibility is key. And with the Bank of Canada potentially cutting interest rates in the future, as mentioned by economist Darren King, there might be some relief on the horizon. But, as always, the market remains unpredictable, and it's essential to stay updated on these developments. Let's dive into the latest report from the Ontario Real Estate Association, which is calling for some significant reforms in Ontario's rental housing market. It's clear that the system is struggling, with too many families, students, and seniors finding it difficult to secure affordable and safe housing.
That's right, Steve. The report, A Fair Rental Market for a Stronger Ontario, outlines 20 recommendations aimed at creating a fair and balanced rental market. One of the key suggestions is to modernize the Residential Tenancies Act, 2006, which could help improve affordability and create a more equitable system for both small and large landlords.
And it doesn't stop there. The report also recommends fixing the dysfunctional landlord and tenant board. This includes moving away from their digital-first strategy by bringing back in-person hearings as the default, while still offering virtual options. This change could greatly improve efficiency and satisfaction among both landlords and tenants.
Yes, and I think the idea of supporting mediation services between landlords and tenants is also crucial. The report suggests exploring models like those in British Columbia to improve dispute resolution. It's all about finding common ground and ensuring that both parties feel fairly treated.
The report also highlights the need for more supply to ease the pressure on the rental market. By providing targeted tax incentives to small landlords who offer new rental units in growing markets, we can encourage responsible property management and alleviate some of the burden on tenants.
Absolutely, Steve. OREA. President Kathy Poland emphasized the importance of accessible and affordable supply across the housing spectrum so families of all sizes can find a great place to thrive. It's about making housing more affordable and keeping the dream of homeownership alive for everyone.
The survey conducted by Abacus Data for OREA shows just how unbalanced the market is perceived to be. With high rental prices and limited availability, it's no wonder that 56% of respondents feel the market is skewed. And only 32% are satisfied with the dispute resolution at the landlord and tenant board.
That's a significant concern. The call for modernizing the Residential Tenancies Act to reflect current market realities is echoed by many, including OREA CEO Luigi Favaro. He points out that a fair market is crucial for housing affordability, and that the proposed solutions could help address these ongoing challenges.
It seems like there's a strong push for the government to take bold action. If these recommendations are implemented, they could provide diverse options for tenants and support all housing providers, ultimately strengthening the housing market.
Today, we're diving into a topic that's on many homeowners' minds: the narrowing gap between fixed and variable mortgage rates. This development is sparking a renewed debate over which option offers the best value in the current market.
That's right, Sandy. With the Bank of Canada's recent rate cuts, the spread between fixed and variable rates has become much narrower than it was just a year ago. This is prompting both new buyers and those looking to renew their mortgages to reconsider their options.
It's interesting because for a while the choice seemed pretty straightforward. Fixed rates were generally more appealing due to the stability they offer. But now, with the potential for further rate cuts in 2025, some are starting to see variable rates as a viable opportunity.
Exactly. Mortgage and real estate expert Victor Tran from rates.ca pointed out that with the current minimal difference between fixed and variable rates, even a single 25 basis point overnight rate reduction could make variable rates more attractive. However, he also warns that rate cuts are never guaranteed, and variable rates do come with risks.
It's a personal decision, really. Tran emphasizes the importance of assessing one's risk tolerance and comfort level. Can the homeowner handle potential rate hikes if the market shifts? It's not just a financial decision, it's an emotional one too.
Absolutely, Sandy. And Chris Allard, an Ottawa broker with Smart Debt Mortgages, mentioned that while some clients might see the potential for savings with variable rates, many still prefer the stability that fixed rates provide. The predictability of fixed rates is a strong selling point for those who are risk averse.
Beyond risk tolerance, borrowers should consider their future plans. For instance, if someone plans to move in the next few years, a variable rate mortgage might be more appealing due to generally lower prepayment penalties compared to fixed rate mortgages.
And let's not forget the broader economic context. Analysts are keeping a close eye on the Bank of Canada's cautious approach. While some predict more rate cuts, others warn that inflationary pressures or global economic shocks could change the outlook entirely.
That's true, Steve. Royal Bank of Canada's senior economist Claire Fan noted that another soft inflation print could increase the chances of further easing. However, BMO's Sal Guattieri pointed out that stubborn core inflation might set a high bar for additional rate cuts.
Ultimately, there's no one-size-fits-all answer here. As a leading mortgage broker put it, it's crucial for mortgage holders to be realistic about their financial situation and their appetite for risk, especially in today's unpredictable market.
Let's dive into the recent strains in Canada's repo market as the Bank of Canada winds down its quantitative tightening. Eric Hertzberg from Bloomberg has reported that funding issues are resurfacing, causing some analysts to suggest that the central bank should intervene.
That's right, Sandy. The Canadian overnight repo rate average, known as CORA, has been sitting about 5 basis points above the Bank of Canada's overnight rate for most of September. This spread is the widest we've seen since January, and if it continues, the central bank might need to step in to ensure smooth market functioning.
Ian Pollock from the Canadian Imperial Bank of Commerce mentioned that without a permanent fix, these issues will keep coming back. He anticipates that the central bank may need to adjust its deposit rate again before the end of the year to address these challenges.
Indeed, Sandy. In January, the Bank of Canada lowered its deposit rate to incentivize large institutions to utilize the overnight repo market more actively. This move was initially successful in bringing Cora closer to the overnight rate. However, recent strains suggest that more adjustments might be necessary.
Andrew Kelvin from Toronto Dominion Bank has also weighed in, stating that while the current situation hasn't reached a level that demands immediate intervention, maintaining market stability is crucial. He suggests that if these issues persist, a deposit rate adjustment could be warranted.
It's worth noting that the Bank of Canada plans to resume asset purchases within the next year to manage its balance sheet size. Simon Deely from RBC Capital Markets believes that given the current market pressures, these purchases could start sooner rather than later, possibly as early as the next Treasury bill auction on September 23rd.
Pollock also highlights a concentration issue with settlement balances among Canada's largest banks. He argues that this imbalance is affecting the velocity of funding in the financial system. While a deposit rate cut could help, the underlying distribution problem remains challenging to address directly by the central bank.
The Bank of Canada has previously stated that these repo pressures don't reflect broader financial system stress, but are due to positioning in bond and futures markets. However, it's crucial for the central bank to closely monitor the situation and be prepared to act if necessary to maintain market stability.
Our next topic takes us into the world of interest rates and what the future might hold for Canadian homeowners and potential buyers. According to a recent report from the Bank of Montreal Capital Markets, the Bank of Canada is expected to make 3 interest rate cuts before the busy spring real estate market of 2026.
That's right, Sandy. This is potentially great news for anyone looking to secure financing for a home. The prospect of lower rates could make mortgages more affordable, which might provide a boost to the housing market. However, it's important to note that these predictions come with some caveats.
Exactly, Steve. The report highlights some underlying economic concerns, particularly within the labor market. The Bank of Montreal's senior economist, Robert Kavchich, points to a clear slack in the job market. This is coupled with slowing wage growth, which is impacting disposable income and subsequently consumption levels.
That's a crucial point, Sandy. The Bank of Canada has expressed concerns over weak demand for surplus labor, which is a significant factor in their decision-making process. With reduced disposable income, the slow consumption could theoretically lead to slower price growth, justifying the rate cuts.
But it's not all straightforward. There's a lot of uncertainty, especially with an upcoming consumer price index report that could change market expectations quickly. If inflation remains sticky or accelerates, the anticipated rate cuts might not occur as soon as some hope.
It's a reminder of how volatile these projections can be. The Bank of Canada has previously warned against slashing rates too early, as it could undermine the progress they've made in controlling inflation. The central bank's neutral policy rate is also a moving target, influenced by both domestic and international factors.
And even if these rate cuts do happen, there's no guarantee they will stimulate the real estate activity everyone expects. Historical examples from the early 80s and 90s show that aggressive rate cuts during frothy markets didn't necessarily translate to increased activity.
Absolutely, Sandy. The economic environment today is quite different from the pandemic era when the easing of credit was aimed at facilitating economic recovery. These forecasted cuts are addressing a shrinking economy and a different kind of uncertainty, which may not have the same effect on the housing market.
It's a complex situation, and it underscores the importance of staying informed and adaptable. Whether you're a buyer or a seller, understanding these dynamics can help you make more informed decisions.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.